Hi everyone, before I start this video, make sure that you're a part of my Discord server by joining the link in the description box below. And in this video, we'll be going over A-Level Accounting 2023 October-November Paper 3-1 question number 1. This is the structured Paper 3 which consists of 3 questions. Each of them will be of 25 marks and the total time limit given for this paper is 1 hour and 30 minutes, which means that ideally you should be spending about 30 minutes in order to solve each question. And in this video as well, we'll be attempting to solve each question we'll be attempting to solve question number 1 under 30 minutes. So without any further delay, let's get started. CB PLC, so this is a public limited company, is a company with 400,000 ordinary shares of $2 each in issue. So this is the nominal rate. Then the directors of CB PLC met to discuss the draft financial statements for the year ended 31st December 2022. That's our closing date. These showed a draft profit for the year of 148,250. Then, the finance director stated that the following matters had not been taken into account when preparing the draft statements. So, we need to take a look at the following errors or following misinformation. The first one is the company had been notified of impending legal actions being taken by 2 dissatisfied customers. The first customer was seeking damages of 8,000. And it was estimated that the legal action had a 40% chance of succeeding. Remember that the chance of succeeding should be greater than 50% for us to consider this amount of damage as part of our contingent liability, as per our International Accounting Standard 37, provisions, contingent liabilities, and contingent assets. But in this case, the chance of succeeding for the first customer is only 40%, which means that there's a higher chance that the company will not have to pay this amount of 8,000, due to which we do not consider this value under our correction, because we do not consider it to be contingent liability for the company. Then the second customer is seeking damages of 12,000. It was estimated that the legal action had a 67% chance of succeeding. In this case, the chance of succeeding is greater than 50%, which means that the company needs to create a provision for this 12,000 that will be a part of our contingent liability. And as per our International Accounting Standard 37, in this case, the contingent liability is just going to be of 12,000. So in order to rectify the first error within our statement of profit or loss, we need to consider this 12,000 to be a part of our overhead, because this will have to be paid by the company. Then for the second information, a credit customer had owed the business 4,750 at the year end, had gone out of business. So that customer is now bankrupt and the company now expected to receive only 0.20 per dollar owed. Okay, so since we will be receiving 0.20, the amount that we won't be receiving will be 0.80. That's 1 minus 0.20 per dollar. And the amount that we won't receive is just going to be the irrecoverable debt. So let's calculate the irrecoverable debt in this case. That is just going to be the total amount of 4,750. And out of the total amount, we will not be getting 0.80 per dollar. So we're just going to multiply it by 0.80, which is also the value of 3,800. In order to rectify it within our statement of profit or loss, we need to subtract this as part of the irrecoverable debt, which is a part of overheads. That's all for the second information. A review on 31st December 2022 had indicated that one of the company's vehicle had a value in use of 17,500 but could be sold for only 16,500 and its carrying value was 21,500. This is for our impairment loss. So within our impairment loss, the first thing that we need to calculate is recoverable amount. Recoverable amount is going to be the higher of its fair value and the value in use. In this case, the value in use is 17,500 and fair value is just going to be the amount that we can receive by selling this asset, which in this case is given to be 16,500. So the higher value is our value in use. 17,500 will be the recoverable amount. Now, in order to calculate whether or not there will be an impairment loss, we need to compare our recoverable amount to the carrying value. We can see that the amount that we can recover by selling this asset is going to be 17,500, but the amount at which we are recording this asset is 21,500, which is higher than recoverable amount, which means that there will be an impairment loss. So impairment loss is just going to be the difference between our carrying value and recoverable amount, but it only occurs in case where the carrying value is greater than the recoverable amount. So that will be 21,500, our carrying value, minus the recoverable amount of 17,500, which results in the value of our impairment loss to be 4,000. Again, the rectification of this is that impairment loss should be treated as our overhead, which means that we need to subtract this 4,000 in order to correct the third information. For the fourth one, the premises had been revalued on 1st January 2022 from 400,000, out of which 50% was land and 50% was building. So the land was of 200,000 building was of 200,000 and it was revalued to 640,000. Now, out of this value, 60% will be land. So that's going to be 640,000 times 60%, which results in 384,000. That's the value of land. Then 40% of it will be the value for building. That will be 640,000 times 40%, which results in 256,000. Now, depreciation for the year for the buildings, which is calculated at a rate of 2% per annum, had been calculated on the original value. Okay. So the depreciation should have been provided on the value of 256,000, but the depreciation was provided on 200,000. Okay, let's calculate the old depreciation. That's going to be the old value of building, 200,000, times 2%, which results in the value of 4,000. Let's calculate the value of new depreciation. That will be the new value of building of 256,000 times 2%, which results in 5,120. And instead of charging this amount, we charged 4,000 as part of our depreciation while calculating the profit for the year. So we are still yet to charge the remaining amount, and the remaining amount is 5,120 minus 4,000, which results in 1,120. So we still need to charge this value as part of depreciation. So the correction of this fourth error will have to be done by subtracting 1,120 as part of the depreciation of buildings from the given draft profit. Now for the fifth one, goods with a cost of 2,600 and a selling price of 5,100 were held by a credit customer on a sale or return basis at the year end. These goods had been treated as being sold when the draft financial statements had been prepared. Remember, we cannot consider the goods sold on a sale or return basis as our revenue. So the rectification of this error is that we need to subtract 5,100 from our sales value, and we need to add 2,600 to our closing inventory value because these goods are yet not sold. The credit customer has not yet made a confirmation on whether or not he will be buying or purchasing those goods. That's all for the given information. Let's move towards the first question. We now need to calculate the revised profit for the year after making the necessary amendments for matters 1 to 5. We've already calculated the necessary amendments. Let's start with our draft profit. It was given in the information above, and that was 148,250. Now we need to rectify the first matter, and the rectification of the first matter is that we need to consider 12,000 as part of the contingent liability, which means that we need to consider this 12,000 to be our overhead as part of the damages. Let's write it down. So 1 is for damages, and the rectification is that we need to subtract 12,000. Let's repeat the same process for second matter. And for our second one, we had irrecoverable debt of 3,800. We just need to subtract this. So second one is for irrecoverable debt of 3,800, which means that we need to subtract it. Now for the third one, it was of impairment loss, which we calculated to be a 4,000, and again this is an overhead, which means that we need to subtract it. So third one is for our impairment loss of 4,000. Then the fourth one was for our depreciation. We are yet to provide the depreciation of 1,120. This is the missing depreciation in this case. So the fourth one is for missing depreciation of 1,120, which we need to subtract. Then we have our final matter, which was of the goods sold on a sale or return basis. So we need to subtract 5,100 from sales, and remember that we add sales while calculating our profit. Now we need to subtract this amount, which means that in total we need to subtract 5,100. Then for the closing inventory we need to add it, but remember that closing inventory is subtracted as part of our cost of sales, and the cost of sales is again subtracted. So that's a positive, negative, negative, which is also a positive. So we need to add 2,600. So the correct rectification would be minus 5,100 plus 2,600, which is also negative 2,500. So we just need to subtract this amount of 2,500 in order to calculate the correct profit. And this is a sale or return basis. So sale or return basis, where we need to subtract 2,500. Okay, now we can calculate the revised profit. That is just going to be 148,250 minus 12,000 minus 3,800 minus 4,000 minus 1,120 minus 2,500, which results in 124,830. That's all for the first part. Let's move towards the second one. We are given additional information. When the draft financial statements were prepared, the market price of one share in CB PLC was 3.90. The directors calculated the price earnings ratio at this time using the draft profit figure. And the draft profit figure was given to be 148,250. Then the amendments were made to the draft financial statements as in Part A, which means that now the new profit is 124,830. When the financial statements were published, it was published after making the amendments. So the profit figure shown would be 124,830 and the market price of one share was 3.10. Let's have a look at our second question. We now need to calculate to two decimal places the change between the price earnings ratio, which the directors calculated, and the price earnings ratio based on the published financial statements. So the formula for price earnings ratio is just going to be the market value per share divided by the earnings per share. And the formula for earnings per share is just going to be profit for the year divided by the number of ordinary shares. So we first need to calculate this ratio, which is the earnings per share. So EPS is just going to be the profit for the year, and that's different for the ratio calculated by directors and the ratio based on published financial statements, because the ratio calculated by directors included the draft profit figure, whereas the ratio based on published financial statements included the revised profit figure. So that's going to be 148,250 for the first ratio and 124,830 for the second ratio. Let's write it down. So 148,250 for the first one, then 124,830 for the second one. Now we just need to divide it by the number of ordinary shares, which was given above. It had a total of 400,000 ordinary shares. That will be our denominator for both the cases, because the number of ordinary shares is not changing. Now the earnings per share for the first scenario will just be 0.37. Whereas the earnings per share for the second scenario is just going to be 0.31. Now we can utilize this formula and calculate our price earnings ratio. So price earnings ratio is just going to be the market price per share divided by the earnings per share. We already have earnings per share right here. So that's 0.37 for the first one and 0.31 for the second one. And we have been given information regarding the market price. So market price per share before, while we utilize the draft profit figure, was given to be 3.9. Then the market price per share after the financial statements were published is given to be 3.1. So for numerator, we have 3.9 in the first case and 3.1 in the second case. And for the first scenario, our price earnings ratio is just going to be 10.54. And for the second scenario, our price earnings ratio is going to be 10. Now we also need to calculate the change. We can clearly see that our price earnings ratio has decreased. We need to calculate the decrease as well. That is of 10.54 minus 10, which results in 0.54. That's all for the second part. Let's move towards the third one. We now need to advise the directors whether or not they should be concerned about the change in price earnings ratio. We need to justify our answer. And this is a 4 mark, so we need to have at least 3 comments and 1 final decision. So the very first thing that we can say is that the decrease is very low and this might not be that significant. So the decrease in ratio is by a low margin, which may be insignificant. Now we can also comment on the differences on the market price per share as well as the difference in our earnings per share. Let's first look at the market price per share. In the previous scenario, we had the market price of 3.9. Now we have it at the value of 3.10. And remember, market price increases when the potential investors or when the shareholders have confidence in the prospects of the company. But in this case, our market value is decreasing, which means that the market is less confident in the prospects of the company. Let's write it down. The market is less confident in the prospects of the company, Then we can also compare our earnings per share. And remember, the earnings per share is previously it was 0.37, now it's 0.31. Although the decrease seems to be very low, the percentage change will be higher. Let's calculate the percentage change in this case. So that's going to be the the new value 0.31 minus the previous value 0.37 divided by the previous value 0.37 times 100%. And this results in the percentage change of negative 16.22%. Okay, we can write this down as well. The percentage change in earnings per share is higher. Okay, now we need to make a decision. So for our decision, let us also calculate the percentage change in the market price. So the new value is 3.10, previously was 3.90 divided by 3.90 times 100%. And this results in the value of negative 20.51%. So we can clearly see that the percentage change in market price per share is greater than the percentage change in our earnings per share. This means that the directors should be concerned about the investors' perception of their company. Let's write it down. Since the percentage change in market price per share is higher than that in earnings per share, the directors should be concerned about the price earnings ratio. Okay, that's all for the third part. Let's move towards the fourth one. The directors believe that the gearing ratio of the company is too high. We now need to explain 3 measures which the company could take which would cause the gearing ratio to decrease. Okay, so our gearing ratio is just the long-term debts, which we can consider to be the non-current liabilities or long-term debts, divided by the equity holdings. And we now need the gearing ratio to decrease. So for the gearing ratio to decrease, either our non-current liabilities or the long-term debts should decrease, or the value of equity should increase. Okay, now let's move towards the 3 measures. The very first measure would be to increase equity by issuing new shares in order to raise enough cash so that we can repay our long-term loans or the debentures. Let's write it down. Issue new shares in order to raise cash to repay the long-term loans. That's the first measure. And the second measure to increase our equity would be to revalue our assets upwards, because that would result in revaluation upwards, which will increase our reserves, right? Let's write it down. Revalue non-current assets upwards in order to increase the reserves of the company. And one way to reduce our non-current liability would be to repay them. And in order for repayment, we can use any surplus funds. So let's write it down. Use any surplus funds. Surplus funds is just the remaining value from our profit after the payment of our dividends, in order to reduce the non-current liabilities of the company. Alright, that's all for the fourth part. Let's move towards the fifth one. Businesses prepare a statement of profit or loss to show how their profits have been calculated. We now need to state 3 other reasons a limited company has for preparing a statement of profit or loss. So for a limited company, the statement of profit or loss is a part of statutory accounts, and statutory accounts are those accounts that needs to be published by the limited company. It includes 5 different accounts. They are statement of profit or loss, statement of financial position, statement of cash flows, statement of changes in equity, and then the notes to the accounts. So that's the very first reason. Let's write it down. it is required as part of the statutory accounts. The second reason is that the statement of profit or loss is also required by the tax authorities so that they can calculate the correct amount of tax. So it is required by tax authorities. All right. Then our final reason is that the statement of profit or loss will also provide information for decision making. So it provides information for decision making. Okay, that's all for the fifth part as well as the entire question. If you found this video useful, make sure you like the video and leave a comment below, and make sure you subscribe to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.